Good morning, I'm Maiki Oreta and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. Finance Secretary Ralph Recto reassures investors that the Philippines remains a safe haven for capital despite global volatility and local political headwinds. A new survey reveals majority of Filipinos believe former President Rodrigo Duterte should be held accountable for his bloody drug war. And the U.S. launches another airstrike on Yemen's capital, Sanaa. All these stories and more coming up. First, let's take a look at how financial markets performed overnight. U.S. stocks rallied Wednesday after the Federal Reserve kept interest rates unchanged as investors weigh the impact of President Donald Trump's tariff policies on the economy and inflation. The Fed held its benchmark rate at 4.25 to 4.50, but signaled two possible rate cuts later on this year. However, policymakers were divided on the path forward, reflecting uncertainty over how to handle the effects of Trump's trade measures.
This is part of the relief rally. Let's remember that we just had a correction. We just dropped over 10%, and we did it in 22 days. Another historic event. A normal correction takes about 80 days. When we've had very sharp, quick corrections, we often have had sharper, quicker recoveries. And if you look in the last 4 trading sessions, including today, 3 very positive days.
The Dow Jones Industrial Average gained 0.9%, the S&P 500 up by 1.1%, and the Nasdaq higher by 1.4%. Now, over in Europe, markets are mixed. The UK's FTSE is flat with a slight upward bias. Germany's DAX lower by 0.4%, and France's CAC 40 higher by 0.7%. Now, the Philippines' balance of payments swings back to a surplus in February, its highest in 5 months, but experts warn of persistent risks. Bangko Sentral ng Pilipinas data shows a 3.1 billion BOP surplus, a reversal from the 4 billion deficit in January. Surplus was driven by foreign currency deposits from the national government, global bond proceeds, and the BSP's foreign investment income. However, analysts note challenges remain. The cumulative BOP deficit stands at $992 million, higher than last year's level due to a widening trade deficit and foreign investment outflows. Despite this, the country's gross international reserves rose to $107.4 billion, providing a strong buffer equivalent to 7.4 months of imports. Economists say sustained dollar inflows from remittances, exports, and investments will be crucial to keeping the BOP stable in the months ahead. Now, the Bangko Sentral ng Pilipinas, or BSP, may cut interest rates by up to 75 basis points this year as inflation cools and as pressure builds to stimulate economic growth amid all of the global uncertainties. Finance Secretary Ralph Recto expects a 50 to 75 basis point rate cut following February's inflation drop to 2.1%, the lowest in nearly 3 years, and well within the government's 2 to 4% target range. He adds that the BSP could start easing as early as April 10, as lower borrowing costs would help drive consumption, investments, and overall economic momentum. Last month, the BSP kept its key rate steady at 5.75%, defying expectations amid lingering global risks, including U.S. monetary policy shifts, geopolitical tensions, and supply chain pressures. A rate cut would bring the Philippines in line with other central banks, moving toward looser monetary policy aimed at sustaining growth while ensuring price stability. Markets will be watching how soon and how aggressively the BSP moves, as the decision will impact everything from business expansion to the stock market sentiment and the peso's stability. Finance Secretary Ralph Recto reassures investors that the Philippines remains a safe haven for capital despite global volatility and local political headwinds. Speaking at an investment forum, Recto says investing in the Philippines is a strategic move as the country continues to be one of the fastest growing economies in the Asia Pacific, even amid the global challenges such as trade wars, high inflation and elevated interest rates. He downplays concerns over the recent arrest of former President Rodrigo Duterte, saying it's unlikely to disrupt the country's political and economic stability. He stresses that the fundamentals remain strong and unchanged. Recto points out that while the stock market experienced some volatility following Duterte's arrest, the peso actually appreciated on the same day, a sign that investors still see strength in the country's economy. He adds that the government remains committed to economic reforms and to policy continuity, ensuring that the Philippines remains an attractive destination for both local and foreign investments. The government is fast-tracking regional development, greenlighting multi-billion peso projects to boost infrastructure and economic growth. The NEDA board has approved several initiatives, including the 56.7 billion peso Panahon ng Pagkilos Philippine Community Resilience Project, or PCRP. Backed by the World Bank, this massive program aims to benefit over 4 million households in 500 municipalities by strengthening local infrastructure and by creating sustainable economic opportunities. NEDA Secretary Arsenio Balisacan, who vice chairs the board, says that these projects reflect the government's push for inclusive growth, ensuring that economic development reaches communities beyond Metro Manila. On another front, a potential trade war is brewing as Japan's automakers face the threat of a 25% U.S. tariffs on vehicle imports, a move that could ripple across global supply chains and trade relations. Japan Automobile Manufacturers Association Chair Masanori Katayama warns that the tariffs could force companies to scale back production, impacting not just Japan, but global automotive suppliers and markets reliant on Japanese vehicles. Japan shipped $142 billion worth of goods to the U.S. in 2024, with cars making up a third of that trade. Restricting this flow could drive up vehicle prices and strain global trade relations. Japanese officials have pushed for tariff exemptions, but Washington has so far refused. This escalating tension raises questions about broader trade partnerships, including Japan's role in the Asia-Pacific markets like the Philippines, where Japanese cars dominate the automotive sector. The Philippine auto industry is off to a strong start this year, showing steady growth in the first 2 months. Our mobility correspondent, G. Baroga, takes us closer to what's driving this industry forward.
The Philippine automotive industry is still cruising at the full speed, with car sales hitting 76,768 units year-to-date, up 6% from the 72,132 vehicles sold during the same period last year. A joint report by the Chamber of Automotive Manufacturers of the Philippines, Inc., or CAMPI, and the Truck Manufacturers Association shows a notable 13% increase in commercial vehicle sales, totaling 60,885 units sold. However, passenger car sales saw a dip, down 12% with 15,883 units sold compared to 18,129 in February 2024. New energy vehicles, which were included in the report for the first time in January, have made a strong debut, with sales reaching 3,416 units, or close to 6% in market share. Among them, hybrids led the charge, though plug-in hybrids experienced a significant boost month-on-month, selling 38 units in February compared to just 9 in January. CAMPI attributes the positive sales trend to a variety of factors, including a stable supply chain, rising demand for electric and autonomous vehicles, and favorable global economic conditions. Consumers are also showing a growing preference for connected, personalized driving experiences, with an increasing shift toward electrified mobility. These trends, combined with ongoing technological advancements, are expected to keep sales revving through 2025. Toyota, led by the Bilyonaryo T family, remains firmly in the driver's seat, holding a commanding 48% market share. For BNC Mobility, G. Baroga.
A new survey reveals that a majority of Filipinos believe former President Rodrigo Duterte should be held accountable for the extrajudicial killings linked to his war on drugs. The survey, conducted by social weather stations and Strat-based group from February 15th to the 19th, shows that 51% agree that Duterte is liable, while 25% disagree. Even in Mindanao, Duterte's political stronghold, nearly half of the respondents share the view that he should be held responsible. We're taking a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. Let's take a look at how bourses in Asia are faring this early morning. Right now, the Nikkei 225 is lower by 0.25%. Hong Kong's Hang Seng Index down by much more, down by 1.4%. Shanghai's Composite in the red as well, lower by 0.4%. Singapore's Straits Times, on the other hand, is bucking the downtrend in the region, higher by 0.6%. Now, here at home, bargain hunting helped lift the main gauge yesterday, pushing the benchmark PSE index higher by 0.45% to 63.13. Analysts say investors took advantage of the decline amid stronger corporate fundamentals and expectations of a rate hike. Now let's take a look at how the Philippine Stock Exchange Index is doing. As of 10:13 this morning, the main gauge is in the green, higher by 25%, 0.25% to 63.28. The broader all shares index is up as well, higher by 0.1% to 37.54. As for the sub-indices, everything is in the green except for the financials index, which is lower by slightly, just by 0.1%. On the other hand, the mining and oil index, mining and oil counter is up sharply, up by almost 2% in early trade. Now, at the foreign exchange market, the peso opened stronger at 57.20 against the greenback from its previous close of 57.30. Overnight, the U.S. Federal Reserve kept interest rates unchanged, reinforcing its cautious stance despite signs of easing inflation. While markets had largely priced in this decision, attention now shifts to the timing of rate cuts, a move that could have far-reaching implications for emerging markets like the Philippines. Now, how will this impact local borrowing costs, the peso, and investment flows? What strategies should businesses and investors consider in this shifting monetary landscape? Joining us to provide his insights is Dino Aquino, the head of fixed income at Security Bank. Good morning, Dino.
Good morning, Maiki. Thanks for having me again.
Oh, it's good to have you. And things have changed
A lot.
since that
Yeah.
discussion. They've changed a lot since that discussion.
Since our last discussion, yeah.
Just a couple of hours ago, overnight, while we were sleeping, the U.S. Fed decided to keep rates steady in a dovish hold.
Yes, it was a dovish hold.
Yeah, this was also highly expected. What are your initial reactions to this decision?
Well, obviously, if you look at the market reaction, it's pretty much positive. Equity markets were higher, bond yields were lower, but I don't think it changes the overall macro dynamic in the medium term.
The overall macro dynamic for the US and for the Philippines.
Yes, in the medium term. Yeah.
Interesting, you pointed that out. Because, apart from their decision to keep rates steady, they also said that they revised the growth targets lower, which is going to be good for bonds. And that's going to mean more rate cuts.
Mean more rate cuts,
okay.
Yeah. They kept their 50 basis points guidance,
Yeah.
which they reiterated last year in December.
Yeah. They also said that inflation over the short term poses no risk.
A little bit of risk.
A little bit of risk?
Just in the short term.
Just in the short term.
Yeah.
Okay. In any case, the Fed's decision to keep rates unchanged gives the BSP room to reduce interest rates.
Yes, it does.
So with that decision, does that strengthen your position that the BSP will cut rates this April 10th?
I think they're likely going to reduce policy rates this April. If you go back February 14, I think it's more of the timing. That's why they actually held rates then. I think 18 out of 19 economists expected a cut last Feb 14, right? But the day prior, if you recall that day, the day prior, the inflation print in the US came in higher than expected. And our peso was closing in on the weak side of things. It's around 58.50 to 59. So the BSP took a cautious approach. So they kept rates steady. Fast forward to now. So for example, the meeting is today. If the meeting is today, definitely they're going to cut. That's what I think, especially after what happened last night.
Okay, there's going to be so much liquidity coming
Yeah.
into the system, especially with the cut in the reserve requirement ratio.
Yeah.
Seen to inject some 320
320 billion.
billion
Yeah.
into the system, with another possible rate cut in the
Yeah.
second half of the year. In this kind of environment, how much liquidity do you expect to flow into the bond market?
It depends to be seen because there's a lot of liquidity right now, but it's all in the short end. So market is pretty much in the duration fear still. They are still on the safe side of things, so they would like to invest in the treasury bills. So if you look at the bid to cover ratio on the recent treasury bill auctions, it's pretty large. So everyone is loaded with cash, but they just are not yet trickling down the yield curve because of possible uncertainties with regards to the tariffs and uncertainties with regards to Trump and, of course, policy uncertainties.
But bond prices move inversely to interest rates.
Yes.
The 10-year bond is a key benchmark. That's looking like the sweet spot right now. Can you tell us why? And that has changed since our last discussion.
Our
Because in the last
discussion,
it was the shorter term ones that were
I
sweet.
remember.
And now it's the 10-year ones. What has changed, why, and how can we position ourselves?
Well, in our last discussion, I did specify the belly, which is the 5 to 7 years tenor buckets as a sweet spot for bonds. Fortunately, it actually gained since we last spoke. So yields are lower on that side of the curve by around 10 to 20 basis points. On the other hand, the 10-year is actually higher by around 5 to 10 basis points. So if you look at the yield curve, it actually steepened. So if you ask me, if you look for value in the curve right now, the 10-year gives you the best value given that the yields have actually steepened quite a lot. And we're still expecting rate cuts. So I guess for me, the 10-year is a sweet spot.
Now's the time to buy before the rate cuts come into play.
I agree. Yeah.
Okay. On another front, I wanted to talk to you about the global macro risks. Taking a look at the three figures, the key three figures shaping policy and a lot of direction in the U.S. There's Trump. There's the U.S. Treasury Secretary, Scott Bessent. And there's Elon Musk with the Doge initiative. What are your thoughts on these guys and how they're shaping things for the rest of the world?
If you're an investor coming into 2025, the first person you'll think about is just one guy. it's the Donald, basically. So he's the monkey
He's a wild
wrench.
card, yeah.
Yeah, and of course with him are those two key figures that you mentioned. Of the three, Scott Bessent, I believe, is the adult in the room. But in essence, if you look at all of their, of course they tweet a lot. I'm not sure if you read their tweets, but they tweet a lot. They give tariffs, they retract, they say things, they retract. But there's three key things that they actually kept reiterating, and they actually continue to communicate to the market on a weekly basis. One is they want the 10-year yield lower. Two is they want to devalue the dollar. And three is to cut the U.S. spending. And it's all the hallmark of the Doge initiative that Elon Musk is heading.
And how do you think that's going to bode for us? How do the thrusts of the Doge initiative, number one, to bring the 10-year yield lower, to devalue the dollar, and to really cut spending, how will that bode for the rest of the world, especially emerging markets like the Philippines?
Secretary Bessent used he used the detox word. So
they're avoiding the word recession.
The R word, yeah, they're avoiding the R word.
It's a bad word, okay.
Yeah, it's a bad word. So he mentioned that we have to shift from government spending to private spending. And in that shift, in order for that to shift, we have to go to an economic detox. So I don't know what he means by that. Does it mean they're going to a recession to actually bring prices down? Or it means it's just laying off a number of workers, because that's one of the key thrusts.
They choose their words so carefully, but at the same time we're left guessing. Okay, on another front, the JP Morgan Asia Bond Index and the Philippines' possible re-inclusion.
Yes.
This is going to be a
That's
game
gonna
changer.
It's going to be a game changer.
Yeah. The Philippines is under review for re-entry into the JP Morgan Bond Index. How transformative could this be for the local bond market?
That's a lot of inflows coming in. That's a lot of inflows.
And that's what we need.
That's what we need.
So,
year to date, in terms of volume, I think the average volume on the bond market's around 30 billion. And maybe half of it is just on treasury bills. So it's quite low, on the low end. So if we get included, that would easily double. So it would attract more foreign investors into the bond markets.
Liquidity was a key issue in 2015 when we were removed from this list. What are the reforms that we need to make sure that doesn't become an issue moving forward?
I think the BTR is in the process of establishing benchmark securities. I've been in the market quite long ago, long ago, 2008. They had these benchmark securities, the 2-year, 3-year, 5-year, 7-year, and 10-year, in where it's called the jumbo bonds. So the liquidity on those bonds are quite large. It's like 700 billion per issue. So those are really, really liquid bonds. So I think the BTR is in the works of doing doing the same thing again in order for the market to be more liquid. Because there's a lot of issues in the market, the bond issuances, but not all of them are liquid. So to improve liquidity, you have to minimize the number of securities that's being issued and then make the market more liquid by trading less securities with more liquidity.
Okay.
So that would improve the liquidity moving forward.
All right. Well, unfortunately, that's all the time we have for today. But Dino, thank you so much for sharing your insights on this topic.
Thank you so much also for having me.
All right. On another front, Ukrainian President Volodymyr Zelensky calls his latest phone conversation with former U.S. President Donald Trump positive and substantive. This marks their first discussion since their clash at the Oval Office more than 2 weeks ago. Zelensky says Trump shared the details of his talks with Russian President Vladimir Putin. He also says Ukraine supports a proposal to avoid striking energy and other civilian infrastructure, a key issue for global energy markets. For the Philippines, this developing situation could impact global oil prices and supply chains, affecting local inflation and business costs. Now, on another front, the U.S. launched airstrikes on Yemen's capital, Sanaa, Wednesday, retaliating against Houthi attacks on commercial shipping in the Red Sea. Local officials report at least 9 people injured, including children. This follows a deadly wave of U.S. strikes last Saturday that killed at least 31. U.S. President Donald Trump warned that Washington will hold Iran accountable for any future Houthi attacks. For the Philippines, escalating tensions in the Red Sea threaten global shipping routes, potentially raising oil prices, disrupting trade, and increasing business costs. And that's it for Business 360. I'm Maiki Oreta. Keep it here on BNC, the Bilyonaryo News Channel.